Hello, and welcome to the July 2021 Advanced Projections Economic Report. Since our last report, the administration has continued to stress its solid and proactive program of slowing down and then eventually eliminating the consequences of COVID through vaccination. The COVID vaccine doses remain highly available in very broad and deep distribution nationwide, with at least 68% of the age 18 plus population, about 175 million people, having received at least one dose of vaccine. Full inoculations have now reached over 59% of that same population. 12 states have reached 70+%. Nearly 90% of the age 65 population, the most vulnerable folks, have now received at least one dose, and 80% have now been fully vaccinated. A large $3.5 trillion infrastructure restoration and improvement package has been negotiated in a bipartisan manner, and now the full Congress must debate and consider it for passage. Real estate prices have slowed their growth, with some minor buyer fatigue setting in and being reported in many areas, and that trend is likely to continue throughout the remains of the summer. But low mortgage rates and short housing stock supplies persist. Recently depressed housing start data suggests that new homes will remain in tight supply and at elevated prices due to material cost issues in new construction. Artificially high year-over-year consumer price index comparisons have boosted talk about the impacts of expected inflation. However, we point out that inflation from mid-2018 to mid-2020 was nearly flat for 2 years. The Fed continues to claim that we will see only a temporary bump in prices lasting perhaps 1 year or so. We now have seen figures confirming the onset of inflation during the second quarter, with the CPI up 2% in just 3 months. We have all noticed price increases for gasoline, some food items, and real estate through the first half of 2021. It's still not something we at AP are going to worry about yet, as there is good reason for us to expect price moderations and even some declines toward the end of the year as material and labor supply imbalances work themselves out. Oil and liquid fuel prices are expected to decline in early 2022 per the EIA as production picks up and again slightly exceeds demand. Margin borrowing again hit a new record high in May, up another 1.7%, and its growth is anticipated to continue for the moment. The party in equities continues almost unabated. Over the past 3 months, we have said there was nothing visible on the horizon that would pierce the bubbles in the equities markets, but that great caution was still warranted in taking personally huge positions in markets which are outrageously risky from valuation standpoints. The Fed, the Treasury, and the popular financial press have continued to discuss how and when the Fed will begin lifting short-term interest rates off of zero. The initial inflation numbers, along with the modestly improving employment numbers, could induce the Fed to first change their rhetoric, then their actual policies. Recession 2020 technically ended in the fourth quarter of 2020, and there have been continuing improvements in expectations for better days ahead. We are awaiting second quarter economic data from the Federal Reserve, as well as second quarter earnings reports from corporate America. Volatile but moderating speculative excesses continue in the equities markets, as well as elsewhere, such as in cryptocurrencies and some precious metals. Due to recent actions by China and also by Tesla, both against the leading crypto, Bitcoin, the overall cryptocurrency markets have had a significant setback, with value losses exceeding $1 trillion alone during May and further declines in June. This would be the second crack in the mirror of excessive speculation due to this large setback in what is largely a peripheral and non-productive financial activity, with the valuations of at least 3 of the largest cryptos declining by over 50% in a matter of a few weeks. Now here's the underlying current socioeconomic situation. While we have clearly outrun our fourth wave of COVID in the USA, as new case and fatality numbers have dropped from their peaks in early 2021, we are still stubbornly at the top of both the global lists for total cases and total fatalities. In spite of having only 5% of the global population, we still have totaled over 18% of the global cases and nearly 15% of the 4 million plus global fatalities. On a per capita basis, however, the U.S. now ranks 21st in terms of fatalities per million people. There is some light at the end of this gruesome tunnel for the U.S., but the more highly contagious Delta variant is now posing the dominant threat to all the unvaccinated individuals domestically and internationally. In countries with lower vaccination resources and rates, case and fatality totals continue to increase, and there is definitely a hard race between dangerous variants and vaccinations that has to be won if the COVID pandemic is to be concluded. The CDC has just said there is a fresh pandemic amongst the unvaccinated in many areas of this country. As of now, July 18, 2021, total U.S. cases have only increased by about 60,000 since last month, compared to more than 6 times that amount in each of the previous 2 months. New cases have begun to move up again, however, from recent averages below 10,000 per day back into the 30,000 plus range. But fatalities have not staged an increase yet. Total U.S. fatalities have reached 606,000, up approximately 6,000 in the past month. The major accomplishment has been to reduce the daily fatality numbers down below 400 per day. This rate is now re-entering an area of societal tolerance, but should continue to move lower if the goal of getting 70% of the country vaccinated by Labor Day is met. Large slowdowns in vaccination rates in certain states are discouraging, and continued irresponsible vaccine bashing and misinformation are becoming commonplace. Offshore, the situation is still dire in many places. There are large shortages of critical care capacities and vaccines for distribution, attributable to several errors in approach, planning, logistics, and as well as manufacturing capacity limitations for equipment and vaccines. Globally, cases have reached 190 plus million, up 16 million in June. At this moment, there are more than 400 to 500,000 new cases being reported daily. Global fatalities have now solidly reached past 4 million with fatality rate of 2.3%. Argentina, Brazil, and India continue to show very dire and increasing stresses from the pandemic. Several countries, including some in Europe, are again going back into lockdowns prompted by the spread of the Delta variant. So far, the existing vaccines appear to protect against the known variants, but the new variants are appearing to be more contagious and more harmful amongst the younger folks under age 45 than the initial version of the virus. Moderna has said that they are already working on a booster vaccine to help with further protection against variants, the first such pharma company to fully commit to it. U.S. health officials are currently claiming there is no evidence yet that a booster shot is needed, but it is encouraging to see that the developers are now thinking ahead and anticipating a problem rather than being months behind and having to react in a renewed emergency. The fatality model graphic that we have been using since it was created on November 20th of 2020 shows that we have been modifying it periodically and showing the danger in having let the pandemic continue its havoc here in the U.S. At the beginning of March, we were still running above this original projection in terms of actual fatalities versus the model, so we would have to wait and see for another couple of months if the problem was truly being solved by the vaccine rollouts, as would be evidenced by actual fatalities declining well below the model's curve and then finally flattening to just minor increases. We have now updated this chart through the 4th of July this year and can now be far more optimistic regarding predicting improvements, seeing that new fatality totals have fallen solidly below the curve, with even better expectations for the coming months. This is one AP prediction that we are particularly happy to have confirmed. June results, as we predicted, now demonstrate a clear gap between actual and the original blue prediction curve. Flattening of total fatalities has begun to evidence itself as well. We hope for continuing domestic deployment of the vaccines, with some expanding public acceptance of the necessity of being vaccinated based on new pleas and incentives to those still holding out. Without the vaccines, U.S. fatalities by July 4th would have exceeded 900,000, based upon our being above the charted curve in the first quarter. So nearly 300,000 lives have already been saved in a matter of a few months, and the benefits will continue to accrue from both health and economic perspectives. If there is no unwelcome turn of events due to some surprises from Delta or other variants, this July report will hopefully contain the last extensive references and charting of COVID's domestic consequences. Now for the current economic environment. In June, unemployment levels moved to a national level of 5.9%, even after a stronger monthly gain of 850,000 non-farm payroll jobs. However, there are still 9.5 million remaining unemployed persons. We have already been anticipating that return to work gains would flatten well below a full recovery level. This is consistent with our view that job gains will continue to return slowly, now taking 12 to 18 months more from today onward to erase all of the remaining job losses created by the pandemic. Many of those old jobs are now permanently gone, and newly created ones will be required to fill in the gap. Plenty of businesses are reporting an inability to fill many of the current 9.2 million open positions, and our interpretation is that the people currently unemployed are either not located or qualified to fill the positions that are opening up. Both of these situations require time to resolve. Some of the country's largest employers are committing to increasing wages and benefits to help fill their openings. We have a couple of charts from the U.S. Bureau of Labor Statistics which show exactly what we've just discussed. This presents a challenge to the current administration and Congress to move forward more aggressively into recovery planning and programs. The current $3.5 trillion infrastructure plan for America could certainly help with long-term employment improvements. One can use a nominal level of 4% unemployment as a target for the Federal Reserve to consider a gradual end to their highly accommodative interest rate and money supply policies beginning in mid to late 2022. We expect a decline in unemployment to below 5% that will trigger a change in Federal Reserve rhetoric, signaling that we should expect to see an end to their current accommodative policies and associated near-zero short-term interest rates. S&P 500 earnings for the first quarter exceeded estimates for 86% of the company's net index. Second quarter of this year earnings reports are anticipated to be ahead of recent expectations, with little evidence of any systemic weaknesses. Year over year, second quarter earnings for the S&P 500 could be up well over 40%, which is strong given the circumstances, but it is hardly anywhere near the amount that would justify the leap in equities prices over that same one-year period. The following chart, courtesy of FactSet and containing our illustrative markups in red, puts this in perspective, demonstrating how much of an anticipation gap now exists compared to just before the pandemic took hold of the markets. Robust growth is expected in the second half of 2021, but projections out into annual earnings for the next year show only an 11% growth in 2022 earnings against the full year 2021. The important point is that Wall Street is currently showing large improvements over dismal figures from the first 3 quarters of 2020, but those would be far less impressive if the COVID decline had not ever created an earnings depression. Equities market pricing has continued moving ahead, with more volatility, still pushing deeper into bubble territory. Recent data suggests that equities have tended to correct 10 to 12 months after the resumption of GDP growth when a recession ends. That suggests a potential window for a correction in the September to November 21 timeframe. Some trigger is usually required, such as a downward surprise in corporate earnings and/or many banks reducing their exposure to market excesses through the deleveraging of margin borrowers. The previous cybersecurity scares, first from the Colonial Pipeline shutdown and then from the JBL beef producer attack, put some temporary fears back into the markets, but it remains to be seen if those are anything beyond just temporary blips, which are already in the rearview mirror. Both events should heighten our awareness of our vulnerabilities in cybersecurity domains and should be considered by specialists in the area as practice runs for even larger attacks that may be politically coordinated from offshore. We believe they are not to be taken lightly, nor as isolated and unrelated events. We continue watching market performance and continuously increasing margin borrowing levels, our favorite tool for indicating speculative excesses. Heavy margin borrowing that is synchronizing with markets making significant new highs is a likely strong leading symptom for a market correction. The latest information on margin debt is from May of this year, shown in a fresh chart below from Advisor Perspectives. We had expected to see an increase during April, which did materialize at about 3%, and it was likely that May would also show another increase, and it came in at up 1.7%. Under similar margin borrowing peaks as seen in the chart that we provided in this section, index drops of 50% of real value followed shortly after each major correction began. A similar sized drop now would take the S&P 500 index down to nearly 2,000. The margin debt trace has now moved up above the market index, which is another early qualitative sign of increased risk. Less drastic corrections can certainly be within our shared expectations. Under similar circumstances in early 2010, the S&P 500 pulled back 13%, which would be about 550 points at current levels. In the past year, the markets have only taken one short-lived break along the way to nosebleed territory from the lows set in 2020. But a return to warm market levels would take the S&P down to about 3,400, and a correction to the mean would be in the 2,700s. We are about due for another such correction, at least, but that is a qualitative opinion rather than a solid, quantitatively driven estimate. Equities cannot continue to defy the logic of value gravity indefinitely. Now for other AP individual indicators. June's closing value for the S&P 500 keeps our APSI indication as red, with that index further up into blatantly overheated territory. One primary indication of the top-heavy nature in equities is the continually widening spread between the S&P 500 and a metric representing the GDP. This gap continues to grow as shown here in our third chart. We see this as an indication that more of our money supply is still being directed towards speculative financial activities rather than into solidly productive activities, that being the production of goods and services. In our form of what is more widely considered to be the Buffett indicator, the upper smooth curve is also the boundary between a warm market and the hot bubble zone. Another chart, which follows the Buffett chart, is one which we first showed in our March report and is also courtesy of Advisor Perspectives. It literally shouts out how risky the U.S. equities markets are using a set of 4 different market indicators, yet very similar to our own in philosophy. The risks continue at all-time highs. The other AP indicators, well, the APMS money supply indicator remains solidly green as the Fed continues with their expansion of the money supply, now reaching $20.31 trillion, up 25% since the beginning of 2020. The $1.9 trillion rescue stimulus earlier this year clearly added further to the money supply and was reflected in the final M2 numbers from the first quarter of the year. One item worthy of note is that the velocity of money again declined as the increased money supply is still not being spent at historically normal rates. Generally declining money velocity has been a fact since the days just before the Great Recession, and the M2 velocity, now at 1.112, sits just above its all-time low of 1.103 set in the middle of 2020. This means it now takes nearly 11 months to turn over the money supply once, when it should normally take about 7 to 8 months, which implies a velocity of at least 1.5. We expect the second quarter velocity to remain flat, with a small upturn then in the third quarter. We are still waiting for the Fed's actual second quarter numbers for the GDP and the velocity of money, hoping they will be out before our coming report in August. Recent action in gold prices show a second test and rebound from support levels just below $1,700 in March, with prices now hovering around $1,800 per ounce. It has just about formed an inverse head and shoulders chart pattern, which would be indicative of a coming strong move upwards. Silver behaved more tamely in June, dropping about $1 to the mid-$26 per ounce range. Rhodium took another fall down to $16,000 per ounce, then climbed right back to recent levels of $18,000 to $20,000 per ounce. Platinum lost about $100 per ounce and now continues to trade between $1,050 and $1,100 per ounce. Month-end prices for gold and rhodium keep our AP PM indicator deeply into the red. The May leading economic indicators from the Conference Board improved solidly, pushing our AP-LI indicator a bit further into green territory. We continue to expect further improvements to LEIs during the next few months. The Conference Board also maintained their improved outlook for economic recovery and that we should expect a more robust recovery well into 2021. So our LEI indicator itself will likely stay solidly in green territory for many months. All of this is predicated upon the absence of any overwhelming equity market correction or a sudden worsening of unemployment during the upcoming months. The Fed now uses newly redesigned LEIs termed normalized OECD leading indicators, which we are adapting for use within our own AP LEI system as a way to confirm the data we currently use from the Conference Board. Our APYC yield curve indicator continues green now for 5 months, the first time since May of 2018. The yield curve continues to move all on its own, maintaining a more normal shape with the short end firmly anchored near 0%, but the long end moving down to and then below 2% for the 20 and 30-year treasuries. Small noise moves showed up in the shorter terms, with the 5-year yield up 8 basis points and the 10-year yield down 13 basis points. The Fed still has little room to do anything on its own with short-term interest rates to further stimulate should it become necessary. If inflation pops up harder or longer than they expect, or if a further expansion of the equity bubble becomes worrisome, the Fed may be forced to react, raising short-term rates, which would likely collapse the equity bubble, assuming it does not do so under its own weight and imbalance. The moves at the long end of the yield curve reflect some nervousness about this scenario on the part of bond buyers as they bid up the prices of longer-term bonds forcing down rates on the 10, 20, and 30-year bonds. The first quarter 2021 GDP grew substantially upward from its enormous decline in the first half of 2020, with the traditional measures and definitions of recession having already indicated a technical end of recession 2020 back in November of 2020. The weekly aggregate measure of economic stability remains in a position of relative safety, but the Fed itself continues to stay with the NBER declaration of recession within all of their data sets. Therefore, our AP-FD indicator for this report remains artificially red, now for more than a full year. Still, though, neither the NBER nor the Federal Reserve have yet to take official notice of this technical end of recession 2020, despite our own months-old declaration that it had ended approximately 8 months after it began. We were starting to wonder when the NBER would make an official call, as they are terribly behind the actual course of events. An article from the Federal Reserve late last year hints that it could still be many more months before an official and retroactive announcement that recession 2020 has ended. So, as an AP subscriber, you have the benefit of a much quicker declaration to that effect when we said it had ended in November of last year. We provide a link in our written report for the Fed article that I just referenced. We maintain a cautiously higher optimistic stance here. The economy is coming out of its COVID lethargy as restrictions on business and social activity have been widely dropped by the wayside, and the barely noticeable fourth wave of COVID infections has already gone away. That assumes that what is going on in the rest of the world will not push something unpleasant back into the U.S. via the Delta variant. There is a much more normal political environment, which of course has both positive and negative elements to it. Market and investor anticipations of the ongoing return to normalcy may continue for many months, but increased dynamics and volatility should still be expected. So in summary, we calculated the actual onset of recession had already begun over a year ago, a fact which was then confirmed by NBER in June of 2020 and became officially acknowledged by the Federal Reserve later in the summer of 2020 with their adoption of NBER's declaration within the Federal Reserve datasets. However, as we have just noted, the technical end of 2020 already occurred by mid-fourth quarter of that same year. 3 of our 6 indicators are now in green territory, and a fourth technically should be green also, that AP Fed indicator. And we reflect this in our restated probability of another near-term recession to just 30%. It would be even lower if the equities markets were more tame in their behavior, as well as having some official recognition of the end in the time frame we have declared long ago regarding the end of recession 2020. We are now entering a period in which our 6 standard indicators can be relied upon again, but still augmented by a direct watch of public health statistics, unemployment figures, GDP, velocity of money, and financial stability indices for several more months. Those are inherently less reliable short-term indicators of recession potential than the 6 AP indicators. We continue to maintain that this is a very risky equity market environment with the potential for significant and protracted drops or even flash crashes based upon the disparities shown in our charts over the past several months. Only those with the highest tolerances for risk should be speculating in the equities markets at these levels. High speculative valuations never persist, and a return to the mean or worse becomes more likely with any new unexpected disruptive influence. The cryptocurrency sideshow has now provided ample evidence for this viewpoint. The only moderating influence in this scenario is that the Federal Reserve has continued to state a longer-term near-zero interest rate environment, and that continues to fan the fires of market speculation. This situation could persist for up to another year, or some new black swan event could pop could arrive to pop this bubble in short order, such as more serious forms of the recent crash of cryptocurrencies, the Archegos Capital hedge fund collapse, or the Colonial Pipeline and JBL cyber attack shutdowns. Not to mention, of course, the dragon of COVID possibly taking another hot breath on the American society and economy. History may repeat itself in that we could expect to experience another roaring 20s as public confidence, optimism, and spending take over once COVID is finally behind us. Despite the glossy economic reputation of the 1920s, there were 3 recessions in it before the big one. The end of the last of those 3 opened the floodgates for the final speculative excesses that popped in 1929. This time around, a more responsive and proactive Fed and a hands-on administration could improve our prospects for controlled and sustained economic gains over the coming decade if we can avoid disruptive financial speculations or political detours along the way. Well, hopefully that's the last of our really long reports. I know we've spent a lot of time talking about COVID. I would like to hopefully make this the last extensive diatribe on that particular problem, but we're going to have to wait until August to see what comes about. In the meantime, thanks for listening, and hope you have a good remainder of July, and we'll talk to you again in about mid-August. Thank you.